Welcome to the StockInvest.us YouTube channel. Today, we will take a closer look into how tariffs, specifically those introduced by President Trump's trade policies, are reshaping United States stock sectors, companies, and ultimately, strategies. Tariffs are taxes on imported goods designed to protect local industries and jobs from foreign competition. For example, a 10% tariff could push the price of a $50,000 imported car to $55,000, making domestically produced vehicles more competitive. During Donald Trump's first term, tariffs were levied on around $380 billion worth of goods. He proposed further tariffs early into his second term, including a 25% levy on imports from Canada and Mexico, although these were paused after negotiations. So, what motivates a government to impose tariffs? They can generate revenue, albeit only constituting less than 2% of United States federal income in 2023. Another reason for tariffs is to shield local jobs and industries by making foreign products less competitive price-wise. This approach was historically seen in actions like the Smoot-Hawley Tariff Act after 1929 stock market crash. Tariffs can also be justified on grounds of national security. Import levies on steel and aluminum were meant to reduce reliance on critical materials for military applications, highlighting geopolitical tactics in tariff applications. Aside from protection and security, tariffs react to other countries' practices. Tariffs on Chinese goods were partly in response to alleged dumping practices, with China accused of selling products below cost to undermine competitors. Retaliation often follows tariff impositions. The Smoot-Hawley Act caused European nations to retaliate, prolonging economic downturns like the Great Depression. Similarly, today, China has announced a 15% tariff on United States coal imports in response to the 10% tariffs the United States imposed on various Chinese goods. This decision directly impacts the global commodities market, particularly the coal trade between the two countries. The cost of tariffs mostly falls on importing companies, which often pass these costs on to consumers. For instance, an online shop might pay higher tariffs on Chinese laptops, ultimately raising consumer prices for these goods. Even seemingly small tariffs can inflate costs for consumers. Retail sectors warned of price hikes on footwear imports, exemplified by a potential increase of $49.99 sneaker to $60.98 when faced with a 15% tariff. While tariffs might encourage buying locally, they can significantly impact pricing and availability, especially if domestic production does not match the volume and cost of imports. Whether tariffs protect jobs is debated. The steel tariffs in 2018 to 2019 revealed the high cost of job protection, costing American businesses and consumers about $900,000 per job saved. Though tariffs contribute to inflation, they only impact specific sectors rather than the economy in its entirety. Removing tariffs during rampant COVID-19 inflation would have minimally reduced price hikes. Industries with international supply chains like automotive and retail felt immediate effects from tariffs. Companies like General Motors and Chipotle swiftly responded to shifts due to additional costs. The auto industry faces disruptions in manufacturing and logistics. Ford and Stellantis evaluate restructuring their North American operations to mitigate increased costs from ongoing tariffs. Railroads, critical in logistics, brace for slowed freight movement, reciprocally affecting major players like Union Pacific and Norfolk Southern, with expected revenue setbacks due to tariffs. Food and beverage industries are not immune. Constellation Brands is already witnessing declining investments, attributing losses to the taxation on Mexican imports essential to their operations. Retail firms with complex international dependencies are reeling. Companies such as Nike and budget retailers like Dollar General face mounting challenges due to higher costs associated with Chinese imports. The energy sector experienced immediate volatility. Tariffs on Canadian oil suggest widened price discounts and even potential drops in natural gas exports, adding complexity to an already volatile market. Commodities, including precious and base metals, reacted strongly. Tariff escalations could push gold prices to $3,000 per ounce and adversely affect metals like copper, showcasing broader market ramifications. Overall, these tariffs highlight potential pressures on stock prices. Sectors aligning around automotive, retail, and energy anticipate possible downturns, with experts forecasting possible 5% reductions in stock prices. As we have seen, Tariffs are an intricate tool in international trade with wide-ranging impacts. We would love to hear your thoughts and strategies regarding tariffs and market effects. Leave your comments below, and do not forget to subscribe to StockInvest.us.